Hello, friends. Welcome to Ria's classes. So, today we are going to start one of the most important theoretical chapters of accountancy, that is, theory base of accounting. So, many students ignore these chapters. They think that accounting is only about journal entries as well as calculations. But let me tell you something very clearly. If you don't understand why accounting rules exist, you will never truly understand how to apply them. So, this chapter basically explains the foundation of accounting. It tells us why accounting follows certain rules. We'll also discuss about generally accepted accounting principles, why consistency matters, why objectivity matters. So today we are going to study it very slowly, line by line. We are going to understand it. So keep your book open, keep your notebook ready, and let's build your foundation. So first of all, whenever we study any subject, science, maths, economics, so it, it always has some theoretical foundation. So similarly, accounting also cannot run randomly. It must follow some principles. So that foundation is called as theory base of accounting. Okay. Now let us discuss the learning objectives. So after studying this chapter, you will be able to identify the need for theory base of accounting. Now let us see first of all, why do we need theory? So imagine if every accountant in India recorded transactions differently. Okay, so one accountant values stock at market price, another values it at cost, another at average price. So would financial statements be comparable? Obviously a big no. So theory basically, it creates uniformity. Then we'll also explain the nature of generally accepted accounting principles. So these are basically accepted rules. They are not random and they are developed over time. We'll also state the meaning as well as purpose of basic accounting concepts. So concepts, what are concepts? Concepts, they are basically assumptions. Okay. So they guide the recording. Without concepts, accounting basically collapses. Okay, so let's now discuss this. First of all, as discussed in the previous chapter, accounting is concerned with the recording, classifying, and summarizing of financial transactions and events and interpreting the results thereof. It also aims at providing information about financial performance of a firm to its various users, such as we have owners, managers, employees, investor, creditors, suppliers of goods and services, and tax authorities, and help them in making important decisions. Okay, so when we say this, accounting is concerned with recording, classifying, summarizing. So recording, what do we do? In recording, we are basically writing down the transactions. In classifying, what we do? In classifying, we group similar transactions. And in summarizing, we prepare financial statements. For example, if you buy goods worth rupees 10,000, then you will, first of all, you will record it. When you are recording all the purchases together, so here you are basically classifying it. And at the year end, when you summarize it into trading account, when you summarize it into trading account, uh, then it is called as this last step is that summarizing. Then we also have, we studied that it aims at providing information about financial performance. So accounting is not just about bookkeeping, its ultimate aim is decision making. Okay, so we also studied it has various users such as owners, managers, employees, investors, creditors, suppliers of goods, and tax authorities. So first of all, when we talk about owners, what do they want? Their main is ways to get profit. When we talk about manager, manager wants control. What does employee want? Employee wants job security. Investor, investor wants return. creditor, wants, repayment. So accounting basically serves all its users. So the investors, for example, may be interested in knowing the extent of profit or loss earned by the firm during a given period of time and compare it with the performance of other similar enterprises. For example, if a company earns rupees 10 lakh, A company is earning 10 lakh, and B company is earning rupees 2 lakh. So what will the investor do? He will compare these figures, compare it, but the comparison is only possible when the rules are same. Okay, so the suppliers of credit, say banker in addition may be interested in knowing the liquidity position of the enterprise. So all these people look forward to accounting for appropriate, useful, for reliable information. For comparison, we have to make the information must be reliable. For making the accounting information meaningful to its internal as well as external users, it's important that the information should be reliable as well as comparable. Comparable, when will it happen? When we are applying the same rules as well as same principles. So the comparability of information is required both to make inter-firm comparison to see how a firm has performed as compared to other firms. Like in this case, we have compared A and B. We compared the profits of the firm investor is doing, as well as to make inter-period comparisons. So, thus, consistency is required throughout the process of identifying the events and transactions to be recorded, accounted for, measuring them, communicating them in the books of accounts, summarizing the results thereof, and reporting them to the interested parties. So, this calls for developing a proper theory base of accounting. So, basically, without theory, chaos would be there, and with theory, structured would be there. Also, the importance of accounting theory need not be overemphasized because no discipline can develop without a sound theoretical base. The theory base of accounting consists of principles, concept, rules, and guidelines developed over a period of time to bring uniformity as well as consistency to the process of accounting, and it enhances this utility to different users of accounting information. We studied, we had owners, we have investors, we have government, we have taxpayers, uh, banks also. Apart from these, the Institute of Chartered Accountants of India, which is the regulatory body for standardization of accounting policies in the country, has issued accounting standards which are expected to be uniformly adhered to in order to bring consistency in the accounting practices. So these are discussed in the sections that follow. So basically, any discipline it cannot develop without a sound theoretical base. For example, we know physics has laws, maths also has some various principles, rules also, and basically accounting, when we say, it has concepts. So when we say discuss about principles, principles, they are basically some general laws, and when we say concepts, it is basically some assumptions that we are making while accounting. And when we talk about rules, rules means practical applications. Guidelines, on the other hand, guidelines, they are some standard methods. So here we also discussed that ICI, Institute of Chartered Accountants of India, uh, it issued accounting standards. So ICI basically is a body which regulates the accounting practices in India. So accounting standards, why are we having accounting standards? To ensure uniformity. Next, we'll discuss about generally accepted accounting principles. Okay, so in order to maintain uniformity, we discussed we need to maintain uniformity as well as consistency in accounting records. Certain rules or principles have to be developed which are generally accepted by the accounting profession. Now, why do we need compare consistency as well as why do we need rules? Because we want to compare the data, and when we are comparing suppose two companies, so the same rules as well as principles, guidelines, it must be practiced across the whole industry, across all the firms and organizations. So these rules are basically called by different names such as principles, concepts, conventions, postulates, assumptions, and modifying principles. So when we say generally accepted principles, okay, let's read further. The term principle has been defined by AICP as a general law rule which is adopted or professed as a guide to action, a set a ground or basis of conduct or practice. The word generally here means in a general manner pertaining to many persons or cases of occasion. Thus, generally accepted accounting principle refers to the rules or guidelines adopted for recording and reporting the business transactions in order to bring uniformity. So basically, these generally accepted accounting principles, these are some rules which have been accepted by a profession. It is not forced randomly. It has been basically developed over years. So when we say that these rules are called principles by different names, principles, concept, conventions. So basically, we are calling it different names, but its main purpose is to provide guidance. Okay, so don't get confused in all this terminology. Okay, when we say principles, generally accepted principles, principle means general law or rule. So basically, like traffic rules we have, which is followed by everyone. So these are also rules which have been provided to be followed in the accounting profession. Now, the generally accepted principles have evolved over a long period of time on the basis of past experience, usage, or customs, statements by individual professional bodies, and regulations by government agency. Among, however, the principle of accounting it is not static in nature; it is constantly influenced by changes, legal, social environment. It keeps on changing as per the need of the hour, as per the situation. It keeps on evolving. Okay, so these principles are also referred to as concepts as well as conventions, and the okay, so here, so hence we started with our generally accepted principles. We started with the discussion of the term principle. Here we discussed also one example also of historical cost. For example, one of the most important rule is to record the transaction of historical cost. So suppose we'll discuss this point further. For example, if building we bought it for 2 crore rupees and we are recording it at 2 crore rupees. So even if the market value becomes 5 crore, we'll record it at 2 crore only because 2 crore we know is we can verify it. It's verifiable. But market value we know it fluctuates. Now, why don't we record it at market value? Because we know it is subjective. And what does accounting prefer? Accounting it prefers objectivity. Okay, so this we have discussed. Now, moving on to this topic concepts and conventions. So, what are basically concepts? Accounting concepts as well as conventions. So, concepts, when we say concepts, are basically s- concepts are some basic assumptions. Okay, so without assumptions, basically, accounting it cannot function. So the basic accounting concepts they are referred to as the fundamental ideas or basic assumption underlying the theory and practice of financial accounting and a broad working rules. What are they? They are rules for all the accounting activities developed by the accounting profession. So for our accounting profession, we have developed these basic assumptions. Now let us discuss these important assumptions. First of all, we have the business entity, money measurement, going concern accounting period, cost, dual aspect, revenue recognition, matching, full disclosure, consistency, conservatism, materiality, as well as objectivity. We'll discuss each one in detail. So basically, there are 13 concepts which are the backbone of accounting. Let us start with the first one, business entity concept. Okay. So when we say the concept of business entity assumes that business has a distinct as well as separate entity from its owner. So when we are saying ABC Limited, so the ABC Limited, it's if it's a sole proprietorship also, so the owner or the business they have a different legal they have a separate identity of its own. So when we say the business, it is not equal to its owner. Okay, sole proprietorship also. It's not the same. So this is an accounting assumption. For example, when we say Ram starts a business with rupees 5 lakh. So in books, what are we recording? We are recording that the business business has received rupees 5 lakh. The capital account is credited. Why? Because why are we doing this? Because the business, it treats owner as separate. Okay. So it means that for the purpose of accounting, the business and its owner are to be treated as two separate entities. Keeping this in view, when a person brings some money as capital into his business, in accounting records, it is treated as liability of the business to the owner, like in capital we are recording. Here, one separate entity is assumed to be giving the money to another distinct business entity. Okay, so our owner is giving to our business. Both are two separate entities. Similarly, when the owner withdraws the money for his personal use, he can withdraw, which is called as drawings. For his personal expenses, when he is withdrawing, it is treated as reduction of this owner's capital. Okay, so the capital that we brought, the money that the owner contributed, what it is called, it's called capital. And when this any money is withdrawn from this capital, it is called as drawings. Okay, for his personal expenses doing any reduction in owner's capital. Okay, so the accounting records are made in the books of accounts from the point of view of business unit and not from the owner's point of view. This is very important. Owner from See, from the business point of view, we know the owner is like a creditor. So capital is basically the liability of business. So uh, also, if the owner has any personal car, if the owner has any personal car, then it will not be recorded in business books, because the personal assets as well as liabilities of the owner are not recorded, because we know they are separate entities. Similarly, personal transactions of the owner is not recorded in the books of business unless it involves any inflow or outflow of business funds. So in short, what can we say? The crux is that only business assets will be recorded, as well as business liabilities. Okay, so one important exam trick question we ask. Okay, so if the owner pays business electricity bill from personal account, should it be recorded? Yes, it has to be recorded, because it is business electricity bill. Okay, but if the owner pays his home electricity bill, then no, it is not to be recorded. Next, we'll discuss about money measurement concept. So the concept of money measurement states that only those transactions and happenings in an organization which can be expressed in terms of money, such as sale of goods or payment of expenses, receipt of income, are to be recorded in the books of accounts. All such transactions or happenings which cannot be expressed in monetary terms. For example, the appointment of manager, capabilities of human resource, creativity. So, what are these? These are basically some qualitative characteristics. It is not quantitative in nature. We cannot quantify it. We cannot express it in monetary terms. So, therefore, it cannot be accounted for. We'll take an example. For example, we do sale of goods of rupees 10,000. So yes, it can be expressed in monetary terms, so we will record it. Salary paid rupees 20,000. Yes, we will record it. But if I say appointment of new manager, so we cannot quantify it in any way. This is just a statement that we are making. So we cannot record it. If I'm telling about my staff's honesty, so it is also qualitative characteristic. I cannot record it. It is not to be recorded. Brand reputation, it is not recorded. Okay, so next point is another important aspect of the concept of money measurement is that the records of the transaction is to be kept not in physical units but in the monetary unit. For example, okay, for example, the business may have like 2 acres of land, it may have 5 machines, it may have 200 chairs, but you cannot add acres, you cannot add this acres plus machines plus chairs. So basically, everything has to be converted into rupees. But if you say, I have land worth rupees 2 crore, I have building worth rupees 1 crore, and I have computer worth rupees 15 lakh. So now the total assets can be calculated by adding these. Okay, so the money measurement is also not free from limitations due to the change in prices. The value of money does not remain same over a period of time. The value of rupee today, on account of rise in prices, is much less than what it was say 10 years back. Okay, so for example, 1 lakh today is not 1 lakh that was 10 years ago. Why? Because over time, because of inflation, it reduces the purchasing power. But we know accounting, it ignores inflation. So sometimes financial statements basically it does not show the true value of an asset. For example, building you bought it for rupees, b- building bought in year 2000, you bought it for rupees 50 lakh, and today its market value is rupees 50 crore, but in books you are still showing it as 50 lakh rupees only unless you do revaluation. So this is one of the limitations of accounting. Then we have going concern concept. Going concern concept, the going concern concept assumes that a business firm would continue to carry on its operations indefinitely, that it is not going to close for a fairly long period of time, and it would not be liquidated in the foreseeable future. So this is an important assumption of accounting because it provides the very basis for showing the value of asset in the balance sheet. Okay, so here what are we assuming? We are assuming that accounting is assuming that the business will continue forever. So we do not prepare the accounts assuming that the business will close tomorrow. Okay, so why is this important? Because we know asset valuation, it depends on this. Now, the asset may be defined as a bundle of services. When we purchase an asset, for example, a personal computer for a sum of rupees 50,000, what are we buying? What we are buying really is the services of the computer that we are going to be getting over its estimated lifespan of 5 years. It will not be fair to charge the whole amount of 50,000 from the revenue of the year in which the asset is purchased. So instead, that part of the asset which has been consumed or used during a period should be charged from the revenue of that period. Okay, so when you buy a machine for rupees 50,000, so basically you are not buying metal. You are basically buying is future services. So if the machine's life is 5 years, then you can see the cost per year of that machine would come out to be 10,000. Okay, so computer bought is 50,000 and its life is 5 years. So basically, instead of charging this whole 50,000 in 1 year, what are we going to do? We are going to spread the cost of over 5 years. So going so this is possible. Why is it possible? Because we are assuming that the business it continues. And if this continuity assumption was not there, then the whole cost would be charged in the same year. If the business closes the next year, so basically then spreading the cost, obviously it would make no sense. So going concern, it helps us to justify this depreciation. Next, we have accounting period concept. So, accounting period basically refers to the span of time at the end of which the financial statements of an enterprise are prepared to know whether it has earned profit or incurred losses during that period, and what exactly is the position of its assets as well as liabilities at the end of that period. Such information is required by different users at regular intervals for various purposes, As no firm can wait for long to know its financial results, as various decisions are to be taken at regular intervals on the basis of such information. Okay, so for example, now the business may run for suppose 50 years, but we cannot wait for 50 years to know the profit. So basically, we have to divide the life into some periods, which is usually like for 1 year. For example, a company started its business in 2000. Okay, so it's still running in 2026 also. So we prepare accounts for like 2001, 2000 to 2001, 2001 to 2, 2 to 3, and so on. So the financial statements are therefore prepared at regular intervals, normally after a period of 1 year, so the timely information is made available to the users. And this interval of time is called as the accounting period. Okay, so why is this information required at regular interval? Because our investors, they want to know about the annual results. Banks wants to know the performance. Governments, they need information about what taxes we have to pay. Also, the Companies Act 2030 Income Tax Act requires that income statement should be prepared annually. Okay, so by law also financial statements must be prepared yearly. However, in certain situations, preparation of interim financial statements becomes necessary. For example, at the time of retirement of a partner, the accounting period can be different from the 12-month period. Okay, for example, listed companies, they publish quarterly results. Why? Because shareholders, they need updated information. Okay, so here if the partner retires mid-year, so accounts will be prepared till that date. So accounting period can be shorter than 12 months. Okay, so let us connect everything that we have studied till now. First of all, we studied about like business entity concept, in which we understood that the business, which basically it separates business from the owner. We also discussed money measurement concept. In this, we record only the monetary transactions. Then we also discussed going concern. Okay, it assumes business will continue for a foreseeable period of time. Then we had accounting period. In this, we are basically dividing the life into yearly periods. So basically, all these together makes accounting possible. So based on this, I'll ask few questions. Okay, so why is capital a liability? Because of this business entity concept. Why brand reputation is not recorded? Because of money measurement concept. If you can't quantify it in monetary terms, you can't record it. Why is depreciation spread over years? Because of going concern concept. Why is profit calculated yearly? Because of accounting period concept. Next, we'll move towards cost concept. Okay, so the cost concept requires that all the assets are recorded in the books at their purchase price, which includes the cost of acquisition, transport, installation, and making the asset ready for use. Okay, so this is very important sentence. So basically, accounting says that the assets we have to record at cost price and not at market value. So cost price, what does it include? Cost price, it includes the purchase price, at what price we are purchasing, as well as we have to bring it from the supplier to the receiver, so to the recipient. So basically, transportation cost will be there. Then, if any machinery we are buying and we have to install it, so installation cost may be also there, and making the asset ready to use. Now we'll discuss an example. For example, old plant we have purchased for rupees 50 lakh. The transportation cost is rupees 10,000. The repairs are rupees 15,000. And the installation is rupees 25,000. So total cost would be 50 lakh plus 10,000 plus 15 and plus 25,000. So 50 lakh 50,000. So basically, students often think that only purchase price matters. No, that's not the case. So cost includes all the expenses which is necessary to bring the asset to its working condition. For example, if machine we have purchased for rupees 2 lakh, freight is rupees 10,000, and installation is rupees 20,000, then the total cost would be 2 lakh plus 10 plus 20, 2 lakh 30,000. So entry will do machinery account debit 2 lakh 30,000 to either cash or creditor. So the concept of cost is historical in nature, as it is something which has been paid on the date of acquisition and does not change year after year. So basically historical means something which is done in past. So once recorded, it does not cost does not change every year. For example, if you purchase the building in 2010 for rupees 2 crore, and in 2025 the market value becomes 5 crore, so it will still be shown at 2 crore unless revaluation is done. Now why are we doing this? Because historical cost we can verify, it is verifiable, it is supported by documents, as well as it is objective. But market value, we know it fluctuates, it is subjective, and it is not reliable. The adoption of historical cost thus brings in objectivity in recording, as the cost of acquisition is easy verifiable from the purchase documents. The market value basis, on the other hand, is not reliable because the value of the asset, it is changing from time to time. It's fluctuating. So making the comparisons between the period to another rather difficult. For example, during inflation, we know the market value it is greater than the book value. So basically, this creates hidden profit. For example, land we have bought for rupees 10 lakh, now it is worth rupees 1 crore. So balance sheet still shows it at 10 lakh. So the financial position may look weak. So advantage of this is objectivity, whereas limitation is that it is not realistic during inflation. Next we'll discuss about dual aspect concept. Dual aspect is the foundation or basic principle of accounting. It provides the very basis for recording business transaction into the books of accounts. This concept states that every transaction has a dual or twofold effect and should therefore be recorded at two places. Okay, so this is very important concept, and it is the base for double entry system. So when we are saying that every transaction has twofold effects, so we know that nothing happens in isolation. If something comes, then something goes. For example, Ram starts a business with 50 lakh rupees. So first effect is cash increases by rupees 50 lakh, and effect 2 is our capital is increasing. If we purchase goods worth rupees 10 lakh, so effect 1 is stock increases, effect 2 is cash decreases. Example 3, if we bought machine for rupees 30 lakh on credit. So effect 1 is machinery, it increases. Effect 2 is, since we are purchasing it on credit, there's no cash outflow. So creditors will increase. So the duality principle is commonly expressed in terms of fundamental accounting equation, which is equal to assets equal to liabilities plus capital. So remember one thing, this must always balance. Let's understand it through an example. So if the initial assets are 0, liability is equal to 0 and capital would be 0. Okay. Now Ram brings rupees 5 lakh. So assets 5 lakh in cash if he brings. So assets would be 5 lakh and capital would be 5 lakh. So basically this equation is balanced. Now we'll see transaction 2. If he buys furniture worth rupees 1 lakh in cash. So here, since he initially had 5 lakh assets, that is the cash he had, when he is purchasing furniture, this 1 lakh would be reduced from 5 lakh. So he will have cash worth rupees 4 lakh and furniture worth rupees 1 lakh. So his total assets would remain 5 lakh only, and we know capital liability plus liabilities, that is 5 lakh. So the equation is still balanced. So this equation basically it never breaks. It must always balance. It must always be equal. If it breaks, then there's a mistake. So this concept is basing. It bases it forms the core of double entry system. That means that every debit has a credit. Next, we'll shift our focus to revenue recognition concept. Okay, so the concept of revenue recognition requires that the revenue for a business transaction should be included in the accounting records only when it is realized. So here arises two questions in mind. First is termed as revenue, and the other when the revenue is realized. Okay, so first, what are the questions coming? What is revenue? What is revenue? And when is it realized? Okay. So revenue is the gross inflow of cash arising from the sale of goods and services by an enterprise and the use of others of the enterprise resources yielding interest, royalties and dividends. Secondly, revenue is assumed to be realized when legal right to receive it arises. That is the point of time when goods have been sold or services have been rendered. Okay. So the main thing here we have to remember is that revenue is recognized revenue is recognized at sale and not when cash is received. For example, goods are sold on 25th March 2024 on credit worth rupees 1 lakh. So you have received cash you have received cash in April 2025. So basically revenue recognition it will happen in March only when the sales have been made and not when the actual cash is received, because your legal right to get that cash, your legal right, it arose in March itself. Second example we can take, like for rent for March, it is received in April. Okay, but still this will belong to March only. Advance income example we can take, like interest for April, it is received in March. It will be recognized in April only. So there's one exception in it. For example, in construction contracts, the revenue is recognized proportionately, and in higher purchase, revenue is recognized as installments are received. So just remember that when we say revenue, it is not equal to cash. Revenue basically depends on earning. Next we have matching concept. Matching concept, the process of it is a process of ascertaining the amount of profit earned or loss incurred during a particular period, which involves reduction of related expenses from the revenue earned during that period. Okay, so this is basically matching concept. In this, the revenue as well as the revenue and the related expense related expense, basically it must belong to the same period. It states that the expenses incurred in an accounting period should be matched with revenues during that period. It follows from this that the revenue and expenses incurred to earn this revenue must belong to the same accounting period. For example, you have sales of rupees 5 lakh, you have cost of goods sold rupees 3 lakh. So what will be your profit? Your sales minus cost, which is equal to 5 lakh minus 3 lakh, that is 2 lakh. So we do not deduct the cost of unsold goods. And the example is you purchase goods worth rupees 10 lakh and you sold goods worth rupees 7 lakh. So we'll only deduct 7 lakh cost from the revenue. So here the expenses basically recognized not when cash is paid but when the asset or service has been used to generate revenue. Uh, for example, salary for March is unpaid, but still it would be an expense of March only. Depreciation example, like machinery, 1 lakh rupees, it has a life of 5 years. So the expense per year would be rupees 20,000. It would not be full 1 lakh in a year. So basically profit equal to revenue minus expense, and these both must be related to the same period only. Okay, so let us discuss some questions based on what we studied till now. Okay, so why can't we take market value and why do we take book value? Because of cost concept. Okay, so why two accounts when we say debit and credit? Because of dual aspect. When should we record the sales? When the legal right arises, not when the cash is actually received. When Why is depreciation yearly? Why is it yearly? Because of matching concept. So understanding all these terms are very important, because if you understand these clearly, journal entries, it will become logical, profit calculation will also become accurate, and financial statements will basically make sense. Okay, next we are going to discuss about full disclosure principle. So information provided by financial statements, they are used by different groups of people such as investors, lenders, suppliers, and others in taking various financial decisions. So in the corporate form of organization, there's a distinction between those managing the affairs of the enterprise and those who are owning it. Okay, so basically there are different groups of people, like we have the investors, creditors, lenders, as well as suppliers. So these people basically they rely only on financial statements. So when we are saying they are relying on financial statements, so our information must be complete. Okay, so financial statements, they are the only or basic means of communicating the financial information to all these related interested parties. So it becomes more important that the financial statement makes a full, fair, and adequate disclosure of all the information which is relevant for taking the financial decision. So when we are saying this uh, full, fair, and adequate disclosure, so full basically means that nothing should be hidden from the interested parties. Okay, then we have fair. Fair means no biasness must be there. And when we say adequate, adequate basically the information must be sufficient. For example, if a company is facing legal case, so even if the case is not finalized, it must be disclosed in notes. Why? Because it may affect future profits. So the principle of full disclosure, it requires that all the material as well as relevant facts concerning financial position of an enterprise must be fully disclosed in the financial statements and the accompany footnotes. Okay, all the material relevant information means, material means something which is important to affect the decisions. So we do not include any small petty items. For example, if the company changes depreciation method, so it must disclose the old method, it must disclose the new method, as well as it must disclose the effect on profit. So to ensure proper disclosure of material accounting information, the Indian Companies Act 1956 has provided a format for the preparation of profit as a profit and loss account and balance sheet of the company, which needs to be compulsorily adhered to for the preparation of these statements. The regulatory bodies like SEBI also mandates complete disclosures to be made by the companies to get a true and fair view of the profitability as well as state of affairs. So basically, law, it ensures proper disclosure must be there. Okay, and SEBI also requires listed companies to disclose the information. So basically, whenever any information is hidden, so basically it means misleading accounts are there. So therefore, disclosure basically ensures transparency. Next, we have the consistency concept. So, the accounting information provided by the financial statements would be useful in drawing conclusions regarding the working of an enterprise only when it allows comparisons over a period of time, as well as with the working of other enterprises. So, basically, when we are saying consistency, it means that we have to use the same accounting methods every year. For example, if the company uses straight line method of depreciation in 2023, so it should be the same in 2024. Otherwise, the profit comparison would become meaningless. Thus, both inter-firm as well as inter-period comparisons are required to be made. So, inter-period comparisons means we are comparing the same company in different years. And when we say inter-firm comparison, it means we are comparing two companies. For example, if in 2023 the depreciation was rupees 1 lakh and in 2024 the depreciation was rupees 3 lakh. Okay, so because the method has changed, so profit comparison has also become invalid. Consistency also eliminates personal bias and helps in achieving the results which are comparable. So, for example, frequent changes, if changes are happening, then it may manipulate profit. For example, if you want to show high profit, then you can change depreciation method. So basically, consistency, it what does, it prevents manipulation. So also the comparison between the financial results of two enterprise would be meaningful only if the same kind of accounting methods and policies are adopted in the preparation of financial statements. If A company uses another method and B company uses another methods of accounting, then we cannot compare these two companies. So for better comparison, for better understandability, we have to ensure that the accounting methods are all uniform as well as they are consistent. However, consistency does not prohibit change in accounting policy. Necessary required changes are fully disclosed by presenting them in the financial statements, indicating their probable effects on the financial results of business. So, important clarification is that if changes are allowed if only if it is necessary, only if it will lead to better presentation, as well as it must be fully disclosed. So basically, change without disclosure is wrong. Change with disclosure is acceptable. Next, we have the conservatism concept or prudence concept. So this is one of the most exam oriented concept. Concept of conservatism, also called as prudence, provides guidance it is providing for recording the transaction in the books of accounts, and it is based on the policy of playing safe. So in accounts, in accounting terms, playing safe, it does not mean overstating the profit, it does not mean understating the losses. So the concept states that a conscious approach should be adopted in ascertaining incomes so that profits of the enterprise are not overstated. If the profits are certain or more than their actual, it will lead to distribution of dividend out of capital, which is not fair because it will lead to reduction in capital of the enterprise. Okay, and the concept of conservatism, it requires that profit should not be recorded until realized, with all the losses, even those which have a remote possibility, are to be provided in the books of accounts. So in simple words, it means that do not anticipate profits, but you have to provide for all the losses. For example, if you're doing closing stock valuation, okay, so value at cost, we take value at cost or market value, whichever is lower. So if the market price falls, then we have to record loss. But if the market price rises, then we do not have to record gain. Also, if 10,000 rupees the debtor may not pay, then we have to create provision for that, even if it is not certain. So basically, we are all the anticipated losses, they should be provided for. For example, legal cases, if we feel that we are expecting some loss, then we have to make provision for that, we have to provide for that. But if expected gain from lawsuit, then do not record it. So basically excessive, but one important warning is that excessive conservatism, it creates hidden reserves, which is not allowed. Next, we'll move to materiality concept. So, the concept of materiality requires that the accounting should focus on material facts. The efforts should not be wasted in recording and presenting facts which are immaterial in the determination of income. Okay. So, basically, materiality, what does it mean? Material, when we say material equal to important. So, if it influences decision, then it is material. For example, if the company is buying new factory worth rupees 5 crore, then yes, it is material. But if it is buying stapler worth rupees 200, it is not that material. So basically, materiality, it depends on the nature as well as amount. Any fact would be considered material if it is reasonably believed that its knowledge would influence the decision of the informed user of the financial statements. Similarly, information about any change in method of depreciation adopted or liability which is likely to arise in future would be significant information. Okay, so for example, stock of eraser, pencil, scales, they are all not shown as assets because whatever the amount of stationery is bought in an accounting period is treated as expense of that period, whether consumed or not. These are just consumables. So the amount spent is treated as a revenue expenditure and is taken to the profit and loss account in which the expenditure occurs because it is something which is immaterial. So why is materiality important? Because it saves time as well as effort. So basically accounting should be practical. Next we have the objectivity concept. So the concept of objectivity, it requires that accounting transactions should be recorded in objective manner. Objective manner means it should be free from biasness of the accountants as well as others. Okay, so there can be possible that when each of the transactions is supported by verifiable documents or vouchers. For example, the transaction for the purchase of materials may be supported by The cash receipt for the money paid if the same is purchased on cash, or copy of invoice and delivery challan if the same is purchased on credit. So basically, whenever we are saying things should be objective, so objectivity basically means it is based on evidence. It is every transaction, it is supported by documents. So basically, all the vouchers that we are issuing, all the vouchers, it must be supported by certain documents or certain evidence. Then it must be verifiable. For example, the purchase, it is supported by invoice, receipt, or delivery challan. So without evidence, we do not have to record it. Now, the historical cost. One of the reasons for the adoption of historical cost as the basis of recording accounting transactions, the adherence to the principle of objectivity is made possible by it. As stated, the cost actually paid for an asset can be verified from the documents, but it is very difficult to ascertain the market value of an asset until it is actually sold. Okay, so historical cost is supporting objectivity because cost here is documented. Market value is basically an opinion, and opinion varies. For example, the land value according to broker is suppose 1 crore, but no sale happened. So you cannot record at rupees 1 crore. So objectivity basically ensures reliability, it ensures trust, as well as it ensures accuracy. Now we'll go through a complete logical connection. Okay, so when we say cost, we'll record it at purchase price. Means all the other cost also you have to include. Then when we say dual aspect, two effects. So this basically is just for an overview revision only. Then when we talk about revenue, means we are going to recognize when earned. Then matching, we have matching is basically we are matching the revenue as well as the expenses. And when we say full disclosure means we have to reveal everything important. Why? Because all the information is necessary for the decision making of the users of financial statements. Then we have consistency. Consistency means we have to follow the same methods so that comparison can be made. Then we have conservatism. You have to be cautious. Talking about materiality. Materiality just simply states that you have to focus on important items. And when we say objectivity, so objectivity basically means that you have to use evidence. So these all points basically ensures fair profit calculation, reliable financial information, as well as decision usefulness. So let us look at a quick recap. So why if there's any legal case, so why should we disclose it? Because of full disclosure concept. Okay, why not record expected profit? Because of conservatism. Why follow the same methods yearly? Because of consistency. Why ignore petty items? Because of materiality. Why need invoice or any supporting documents? Because of objectivity, because you need evidence. It should not be based on biasness of the of the person making the financial statements. Okay. Next, we'll move towards the system of accounting. So here we are going to cover the systems of accounting, the basis of accounting, and the accounting standards. So all this portion is going to basically explain how the transactions are recorded, when the transactions are recorded, and why the accounting standards are necessary. So let's start. The systems of account recording transactions in the books of accounts are generally classified into two types: double entry system as well as single entry system. So, double entry system is based on the principle of dual aspect, which states that every transaction has two effects: receiving of a benefit and giving of a benefit. So, basically, these two main lines, what are we understanding from here? That accounting basically, it does not record things randomly. It follows a structured system. Okay, and the main two systems are double entry system and single entry system. So double entry system, when we are saying that it's a complete system, as the both aspects of transactions are recorded in the books of accounts. So basically there is a dual aspect involved in it. So we have already learned that every transaction, it has two effects. And what does this double entry system do? It records both the aspects. Okay, so whenever something comes in, something goes out. For example, when we buy goods for cash, then we are receiving the goods. We are receiving the goods, and what we are given? We are giving away cash. So basically, there are two effects, and at least two transactions, two accounts are also affected here. So each transaction has two or more accounts and is recorded at different places in the ledger. For example, if we pay salary to employees, 10,000 rupees, then what are the two accounts affected? Salary account, because our expenses increasing, as well as cash account, because our asset is decreasing. Here we had read that every debit has a corresponding credit. Every debit has a corresponding credit. What do you mean by this? So this is basically the golden rule of double entry. Debit must be equal to credit. If it is not equal, then there's a mistake. For example, Rav invests rupees 1 lakh, then cash account will be debited by 1 lakh, and capital will be credited by 1 lakh. So here the debit is always equal to credit, so thus it is balanced. And double entry system is a complete system because both the aspects of transactions are recorded. So basically it is giving us the full picture by recording all the both the sides. So it reduces fraud. Also we make the trial balance in it. So it helps this trial balance thing, it helps to check the arithmetic accuracy. So basically double entry system, it is complete because we are recording both the aspects. It is accurate, it is reliable, as well as it is suitable for all sizes of business. Now coming to single entry system, it's not a complete system of maintaining the records of financial transaction. It does not record the twofold effect of each and every transaction. Okay, so basically it is not like in dual entry system, double entry system, it is not recording both the aspects. So sometimes only one side is recorded. So thus there is no uniformity in it. Now some small shopkeepers, what do they do? They just record they just maintain cash book, they maintain personal accounts, but they do not maintain any full records. So when the accounts maintained are incomplete, what will happen? Profit calculation. Profit calculation will be unreliable, as well as it is not suitable for large business. Thus we can say that double entry system, it is a proper system It's a proper system, where a single entry system, it is an incomplete system. Next, we'll move towards the basis of accounting. Okay. So this section basically answers a very important question: when to record the transactions. So from the point of view of timing, the timing of recognition of revenue and cost, there can be two broad approaches to accounting. These are cash basis as well as accrual basis. So first of all, let's discuss cash basis. So under the cash basis, entries in the books of accounts are made when cash is received or paid, and not when the receipt or payment becomes due. So, so here we are recording the transaction only when cash it changes hands, not when the actual transaction happens. For example, rent paid for December, it is rent for December, it is paid in January. So under cash basis, we will record it in January when it is actually paid. Credit sales in Jan. We have made credit sales in Jan, but the cash is actually received in April. So under cash basis, we will record in April. So thus this system is basically incompatible with the matching principle, which states that the revenue of a period is matched with the cost of the same period. Because revenue and expenses here, we know revenue and expense, it may belong to different period here. So basically the profit that we are calculating, it becomes inaccurate, and thus it will not be reliable, and the users of the information, they cannot use it as a reliable information for making decisions. So profit would be cash received minus cash paid. So thus this is not a true profit. Under accrual basis, however, revenues and costs are recognized in the period in which they occur rather than when they are paid. So a distinction is made between the receipt of cash and the right to receive cash, and payment of cash and legal obligation to pay cash. So here, uh, okay, thus under the system, the monetary effect of a transaction is taken into account in the period in which they are earned rather than in the period in which the cash is actually received or paid by the enterprise. So this is a more appropriate basis for calculation of profit, because expenses are matched against revenue earned in relation thereto. Okay, so now let's discuss. So in accrual basis, what is happening? We have to record transaction when it happens and not when cash is received or paid. Now, for example, if goods are sold on credit in March, so under accrual system, we are going to record it in March even if it is paid in April. Salary, it's unpaid for March. So under accrual system, we have to record it in March only. So distinction is made between the receipt of cash and the right to receive. So what is the meaning of this? The cash received is not equal to revenue earned, and cash paid is not equal to the expense incurred. Now, why is this accrual method better? Because here it is matching the revenue with expense. Also, it shows correct profit and is used by companies. So we can conclude that cash basis basically it is simple but it is inaccurate. Accrual basis on the other hand is accurate as well as it is widely used. Now let us discuss accounting standards. So accounting standards basically are the written policy documents covering the aspects of recognition, measurement, treatment, presentation and disclosure of accounting transactions in financial statements. So basically there are some official rules which is issued by ICI which must be followed. So Accounting standards is an authoritative statement issued by ICI. It's a professional body of accounting in our country, Institute of Chartered Accountants of India. The objective of accounting standard is to bring uniformity in different accounting policies in order to eliminate non-comparability of financial statements for enhancing reliability of financial information. Okay, so why does it bring uniformity? Because without standards, one company will value stock at cost, another will value it at market value. So basically, our comparison will become impossible. So standards basically ensure that you follow the same treatment for the accounting transaction, you follow the same disclosure, as well as it ensures easy comparison. Now let us look at why was there a need for accounting standards. So accounting extends information to various users of information. We know all creditors, our debtors, our management, our government, shareholders. So accounting information can serve the interest of different users only if it possesses uniformity and full disclosure. Then only the information would be reliable. So there can be alternate accounting treatment and valuation norms which may be used by any business entity. So accounting standard facilitates the scope of those alternatives which fulfill the basic qualitative characteristics of true and fair financial statements. Okay, so we read that there may be alternative accounting treatments. So alternative accounting treatments, for example, if you're calculating depreciation, okay, depreciation is nothing, just a reduction in value of the asset. Okay, so for depreciation, we can follow the straight line method as well as we can follow written down value method. So the standard is doing what? Basically it is restricting the options. Now let us further see the benefits of accounting standards. First of all, accounting standard helps in eliminating the variations in accounting treatment to prepare financial statements. Okay, so basically the same method is used by all, so variation it is eliminating. Then accounting standard may call for disclosures of certain information which may not be required by law, but such information might be useful for general public investors as well as creditors. Okay, so sometimes law does not require detail, standards require. So thus there is more transparency. Also, accounting standards facilitate comparability between financial statements of inter and intra companies. For example, we can compare company A versus company B, or we can compare a company's 2000 years performance versus 2024. So all this is possible when we are following some set of rules, which is the accounting standards. Now there are some limitations also of accounting standards. First of all, accounting standard makes choice between different alternative accounting treatments difficult to apply. So when we have alternatives, it's difficult to choose. It is rigidly followed and fails to extend flexibility in applying accounting standards. So it may not be suitable for all the business equally. Third, we have is accounting standards cannot override the statute. The standards are required to be formed within the ambit of prevailing status. Okay, so standards basically they have to follow some legal provisions, and law always has higher authority over these standards. So till now we studied about systems of accounting, which is in that way discussed how to record. In basis we discussed when to record, and in standards we discussed how to ensure uniformity. So basically together they make the accounting systematic, reliable, comparable as well as transparent. So next we are going to discuss another important topic, which is the goods and service tax. Okay, so till now we have studied about accounting concepts and standards. Now we are going to connect the accounting with taxation. So what is GST, goods and service tax? GST basically it affects the businesses, consumers, government as well as the accountants. So we'll study this from absolute basics slowly, clearly as well as deeply. So let's start. GST is a destination based tax on consumption of goods and services. It is proposed to be levied at all stages, right from the manufacture up to the final consumption, with credit of taxes paid at previous stage availed as set off. Okay, so when we say GST is a destination based tax, it means the tax is collected where the goods are consumed. So consumption, who does the consumption? Consumption is by final use by the consumer. So basically GST revenue it goes to the state where goods and services they are consumed and not where goods and services they are produced. For example, if we have a factory in Maharashtra and the customer is in Gujarat, then GST will go to Gujarat, which is the place of consumption. Okay, we also studied it is levied at all stages, right from manufacture to final consumption. Okay, so earlier system we had excise duty, VAT, service tax, entry tax, luxury tax. So GST basically it has replaced all. And credit of tax paid at previous stages available as set off. Okay, so this is basically what is called as input tax credit. We'll discuss an example. Okay, for example, the manufacturer sells goods worth rupees 1000 GST at the rate 18% is there, so the GST would be rupees 180. Now the dealer sells the goods for rupees 2000. So this manufacturer, this is dealer. So the GST would be 18%, that is rupees 360. So now this dealer he has paid this GST 180 rupees, so he can deduct the 180 rupees already paid. So basically, out of this 360, he has already paid 180, so so extra he has to pay 180 only. In a nutshell, only the value addition will be taxed and the burden of tax is to be borne by the final consumer. For example, raw material, raw material we have rupees 1000, finished goods we have rupees 1500. So the value addition is rupees 500. So GST is basically charged effectively only on rupees 500. And we say the burden of tax is to be borne by the final consumer. So here the business is basically just collecting the tax. So ultimately the consumer has to pay. Okay, so we'll further discuss about this destination based tax. So the concept of destination based tax on consumption implies that tax would accrue to the taxing authority which has a jurisdiction over the place of consumption, which is also termed as place of supply. So this basically means that the state where the goods are used gets the revenue, not where the state where the factory is located. So India has a dual aspect with center and state simultaneously levying on a common tax base. These are the three main components of GST, which are CGST, SGST. CGST means Central Goods and Service Tax. Okay. So India is a federal country, so it has basically two components. So central goods and service tax. This is collected by the central government, and SGST, it's state goods and service tax. It is collected by state government. Okay, now let us see an example. Ramesh sell goods worth rupees 10,000 in Punjab. So the GST rate is suppose 18%, 9% suppose CGST, and 9% SGST is there. He is selling it within the state only. So basically, 900 rupees will go to the central government. This is 9% of 10,000, and 900 rupees will go to Punjab government. So basically, this 18% of 10,000, that is 1800, is being split equally into two. Then we have IGST. IGST is basically, it is charged on transfer from one state to another. So if the goods move across the states, then only IGST it applies. For example, Ramesh is in Madhya Pradesh. He sells to Anand in Rajasthan. Sells good worth rupees 1 lakh. So GST rate, if it is 18%, then IGST would be charged rupees 18,000. So this entire amount is basically collected by the central government and it is later adjusted between the states. Let us see the constitutional background. So India is a federal country where both the center as well as the states have been assigned the powers to levy and collect taxes through appropriate legislation. Both the levels of government have distinct responsibilities to perform according to the division of powers prescribed in the constitution, for which they need to raise resources. So basically, India has central as well as state government, and both of them they have the power to levy tax. Okay, so a dual GST will therefore be in keeping with the constitutional requirements of fiscal federalism. Hence, the center will levy and administer CGST and IGST, while respective states will levy and administer SGST. So the Constitution of India has been amended for this purpose. So basically, this GST has been introduced through constitutional amendment. Okay, so the center will collect the CGST and IGST, whereas state only SGST. So basically, this maintains the fiscal federalism. Now, let us see some of the characteristics of goods and service tax. First of all, GST is a common law and procedure throughout the country under single administration. So, same procedures everywhere. So, basically, there is uniformity. Second is it's a destination based tax we have already discussed. The tax is where it is consumed. Okay, so it is levied at a single point at a time of consumption of goods, not where it is produced at, but at the place where it is consumed. Third, GST is a comprehensive levy and collection on both the goods and services at the same rate with benefit of input tax credit or subtraction of value. So basically GST it covers both goods as well as services. Earlier separate taxes were there, now it has been unified. Then we have the minimum number of rates of tax. It does not exceed 2. The rates have been limited, not too many slabs are there. Then there's no scope for levy of cess, resale tax, additional tax, turnover tax, etc. So earlier many small taxes were there, but now it has been removed. There is no multiple levy of tax on goods and services such as sale tax, entry tax, octroi, entertainment tax, or luxury tax. So earlier, what we had excise plus VAT plus entry tax. Now only we have GST. So basically, there is no cascading effect. So let us do this question. State how the GST rates will be applicable if CGST is 9%, SGST is 9%, IGST is 18% in each of the following situations. Okay, so let's see the first question. Goods worth rupees 10,000 is sold by a manufacturer 1 in Maharashtra to a dealer A in Maharashtra. So see, it is both states are same within the state only. So this is intra-state sale. So we have to apply the rate of 9% CGST, which is 900 rupees, SGST 900 rupees, which is 9% of rupees 10,000. Second, we have dealer A sells goods worth rupees 25,000 to dealer B in Gujarat. Okay, so dealer A, okay, so dealer A of Maharashtra is selling to dealer B in Gujarat. So this is basically across the states, so interstate. So straight away IGST will apply 18% of rupees 25,000 equal to 4,500. Third case we have dealer B sells goods to Sunita in Gujarat worth rupees 30,000. Okay, so this dealer B, so B we know is of Gujarat, so he is selling to Sunita, who is also of Gujarat. So in this, intra-state will apply because same state only. So on 30,000, we'll apply. So the CGST would be 2700, SGST would be 2700. Now in the fourth case, Sunita sells goods to Ravindra in Rajasthan worth rupees 65,000. So Sunita is of Gujarat selling to Ravindra in Rajasthan. So it's this interstate. So 18% IGST will apply. 18%. So basically amount is 11,700. Let us see some of the advantages of GST. First of all, introduction of GST has resulted in the abolition of multiple types of taxes in goods and services. Okay, so basically simplifying it. It simplifies it simplifies the whole system. Then we have second point, we have the GST. Basically it has widened the tax base. It has increased revenue to the center and state, thereby reducing administrative cost for the government. So basically under GST more businesses have been registered. So because of this more revenue is being generated. Third, GST has reduced compliance cost and increases voluntary compliance. So earlier many returns were there. So now a single system has been made. So it has reduced compliance cost also. GST has affected rates of tax to the maximum of two floor rates. So basically the structure has been simplified. Simpler structure is there. GST has removed the cascading effect on taxation. Tax on tax. Cascading effects means tax on tax. This has been removed. Then GST will result in enhancing the manufacturing and distribution system, affecting the cost of production of goods and services, and consequently the demand and production of goods and services will increase. So basically because of this, there has been lower cost of production, and because of this, so even the cost will decrease, then the demand for the goods will increase. So it will eventually promote economic efficiency and sustainable long-term economic structure, as GST is neutral to business process models. So basically all this, since it's neutral to business structure, so basically it encourages investment. Also it gives competitive advantage internationally because the exports become competitive. Okay, so earlier systems we had multiple taxes, we had tax on tax, we had a complex compliance. So after GST, single system is there. There's input, credit, uniform rates, as well as transparent taxation. So GST is basically not just a tax theory, it affects the real accounting entries, invoice preparation, compliance, as well as financial reporting. So understanding GST basically it will help you practically stronger as an accountant. Now let us revise some of the key terms that we studied in this chapter. So first of all, we had discussed about cost. We know cost means the purchase price including all the expenses necessary to bring the asset into its working condition. And like we had discussed, if machinery is rupees 2 lakh, freight is rupees 10,000, the installation is rupees 20,000, then we'll add all of them. So the total cost would be 2 lakh 30,000. 2 lakh plus 10,000 plus 30,000. Okay, so in matching, what did we study? Matching only the important information. Oh, sorry, materiality. In materiality, we studied that only the important information should be disclosed. For example, small items like pencils, it should be treated as an expense, and large asset purchase, it must be disclosed. Material, whether it is material or not, it depends on the amount as well as the nature. We also discussed about matching concept. So in matching concept, basically the revenue as well as the related expense, it must belong to the same accounting period. We discussed like sales, we have 5 lakh, Cost of goods sold we have 3 lakh. Profit we have 2 lakh. So we do not deduct the cost of unsold goods. Then we have objectivity. In objectivity, basically the transactions they must be supported by documents like invoice, receipt, voucher. So without the evidence, no recording should be there. Then we studied about consistency. Consistency means the same accounting method should be followed every year. If straight line method depreciation, for example, is used this year, it should continue next year also. Otherwise, the comparison would fail. Then we have dual aspect also, like every transaction has two effects. For example, asset equal to liabilities plus capital. This is the golden equation. Then we studied about conservatism. Conservatism states that do not anticipate profits but provide for all the losses. For example, like closing stock, it is valued at cost or market value, whichever is lower. Then we studied about going concern. So in going concern, basically the business is assumed to be to continue indefinitely for a foreseeable period of time. So therefore, depreciation is spread over the years. Then we studied about comparability. In comparability, basically, financial statements should allow comparison. We can do inter period comparison, or we can do inter firm comparison also. Then we also studied about full disclosure. So, in full disclosure, all the material facts must be disclosed. For example, if there's any legal case, if there's any change in accounting policy, it must all be disclosed. Then we also discussed revenue realization. So, revenue basically is recognized when legal right arises and not when cash is received. For example, credit sale. The revenue is recognized at sale date. Then we have accounting period also. In this, the life of the business is divided into a specific period of time, generally 1 year periods. So profit is calculated annually. Money measurement, only the transactions which is measurable in money terms, monetary terms are recorded. For example, employee honesty, no, we cannot quantify it, it is not recorded. Then we have accounting concept. They are the just basic assumptions of accounting. Then we had generally accepted accounting principle. These are basically the rules guiding the accounting practices. Then we also discussed about GST. GST is a destination based tax on consumption. So these terms basically they are not just definition, they are the pillars of accounting. Now we move to a structured summary. We'll explain each summary point in detail. Okay, first of all, we have generally accepted accounting principle. So in this we had discussed these principles. They ensure uniformity, consistency, as well as comparability. And without these generally accounting accepted accounting principle, company A, it may show high profit, company B may show low profit, even if both are similar. So basically these principles they prevent confusion. Then we also discussed about the basic accounting concepts. So these are basically the fundamental assumptions. Okay, so the guide in recording, measuring, as well as reporting. Without them, the accounting would collapse. Next, we discussed about business entity concept. So basically, the business is separate from the separate entity from its owner. If the owner invests rupees 5 lakh, then we discuss that cash would increase, capital would increase, because capital is a liability from business viewpoint. Next, we discussed money measurement concept. So in money measurement concept, only the measurable transactions are recorded, measurable in terms of money. Limitation like value, value of money changes over time, and thus the inflation and all it may not be reflected. Then we discuss going concern. It assumes that the business will continue for a foreseeable period of time, and there is no intention to shut down the business in the foreseeable future. So therefore, for example, for because of this, the depreciation is charged yearly. If the business is closing tomorrow, obviously the entire asset cost would be expensed immediately. Next, we have accounting period. Okay, so accounting period in this basically the business life cycle. It is divided into financial years. Okay, so Companies Act basically requires annual statements. Some companies publish quarterly statements. Then we discuss cost concept. Assets are basically recorded at historical cost, the cost price. Advantages is that it is objective, it is verifiable, but the limitation is it does not show the asset at the current market value. Then we discussed about dual concept. Dual concept is basically the foundation of double entry. In this asset, the main formula is asset equal to liabilities plus capital. This equation must always be balanced. If this is not balanced, then some mistake is there. For example, Ram invested business 1 lakh rupees. He bought goods worth rupees 20,000. Okay, so basically he has cash cash 80,000 because already he has given 20,000. So cash now he's having 80,000, stock he's having 20,000, and capital is 1 lakh. So thus this is balancing. Okay. Next we have revenue recognition. Revenue is basically recognized when it is earned. Credit, because of this, the credit sale, it is recognized immediately. The rent for March received in April, it will be recorded in March only because it pertains to that, not when the rent is actually received. Then we have matching concept. Matching concept basically expenses are matched with the related revenue. For example, if salary is unpaid, it's still an expense. Prepaid insurance, it's not full expense. Full disclosure. Full disclosure states that all the material facts must be revealed, and in this, transparency is key. Consistency, basically, we have to follow the same accounting policies over the years, and changes allowed only if it is necessary as well as when it is properly disclosed. Next, we discussed about conservatism. Basically, in this, it states that provide for all the anticipated losses, do not record unrealized gains. Then we discuss materiality. Our focus should be only on the significant information, like small expenses, it may be treated simply. Then we discussed objectivity. So, accounts must be free from personal bias, it should be supported by evidence. Under systems of accounting, we discussed that there are two systems of recording business transactions: double entry system as well as single entry system. So double entry basically it records both the aspects. Then we also discussed basis of accounting. In this we have cash basis where we record when cash is received or paid, and then we had accrual basis also. In this we record when the transactions occur. So accrual is more appropriate for profit calculation. Then we have accounting standards also. These are basically the written rules which is issued by ICAI. Okay, so it ensures uniformity as well as reliability. It cannot override law. Then we discussed about GST, which is a destination based tax. It is levied at all stages. Input tax credit is available, and the final burden is on the consumer. Now let us discuss some questions for practice. Okay, first of all, we have, why is it necessary for accountants to assume that the business entity will remain as a going concern? Obviously, because asset valuation and depreciation depends on it, and without going concern, what will happen? The entire cost would be expensed immediately. Second question, when should revenue be recognized? Are there exceptions to the general rule? Okay, so we have to recognize revenue when the legal right arises. Exceptions are like in long term contracts, in percentage completion method, hire purchase also. Then we have, what is the basic accounting equation? Basic accounting equation is assets equal to liabilities plus capital. We have questions related to realization concept. Okay. So first of all, the realization concept determines when goods sent on credit to customers are to be included in the sales figure for the purpose of computing the profit or loss for the accounting period. Which of the following tends to be used in practice to determine when to include a transaction in the sales figure for the period when the goods have been? What should be the answer? When the goods are delivered or the legal ownership legal ownership is transferred, not when the order is received or when the cash is received. Now let us discuss the fifth one. If a firm believes that some of its debtors may default, then it should act on this by making sure that all the possible losses are recorded in the books. So this is basically an example of conservatism or prudence concept. Second, we have the fact that a business is separate and distinguishable from its owner is best exemplified by business entity concept. Third one, everything a firm owns, it also owns out to somebody. This coincidence is explained by dual aspect. Fourth one, the dash concept states that if straight line method of depreciation is used in 1 year, then it should be used in next year also. This very easy consistency. A firm may hold stock which is heavily in demand. Consequently, the market value of the stock may be increased. Normal accounting procedure is to ignore this because of conservatism or prudence. Next question we have is, if a firm receives an order for goods, it would not be included in the sales figure owing to revenue recognition or the realization concept. Why? Because sales are recorded only when the goods are delivered or when the legal right to receive the payment arises, and not when an order is merely received. Next one we have, the management of the firm is remarkably incompetent, but the firm accountants cannot take this into account while preparing the books of accounts because of money money measurement concept. Why? Because only the transactions which are measurable in monetary terms, they are recorded, and management incompetence, it cannot be measured in money, so basically it is not recorded in books of accounts. So students, today we successfully completed this entire chapter on the theory base of accounting. This chapter may look theoretical at first glance, but in reality it is the backbone of the entire subject of accountancy. Okay, so we understood that accounting is not a random process. It is built on structured principles, it is built on concepts, it is built on standards that ensures accuracy, uniformity, reliability, as well as comparability. We also studied about generally accepted accounting principles, why it is necessary, why accounting concepts like business entity, going concern, dual aspect, they form the foundation of all the journal entries, why matching as well as revenue recognition ensures correct profit calculation, why conservatism protects against overstatement of profit, why consistency as well as full disclosure helps to maintain transparency and trust. So we also understood the importance of accounting standards and how GST has transformed the taxation structure in India. So basically, every journal entry that you're passing, every ledger you prepare, every trial balance you tally, and every financial statement you draft, all of it is controlled by the concepts we studied in this chapter. So, if your foundation here is strong, the rest of the accounting will become logical, structured, as well as easy. So remember that accounting is not just about memorizing entries, it's about understanding the reasoning behind them. So strong concepts basically create strong accountants. So if this detailed explanation helped you understand this chapter clearly, don't forget to like this video, share it with your friends, and subscribe to Ria's classes for more concept based in-depth accounting sessions. Keep learning, keep practicing, and I'll see you in the next class. Thank you. Bye bye.